Let's get to our wrap the week session, trying to make sense of this market today, and just to really quickly summarize what we saw, and then we'll get to the Mindful Investor Live chart list. Just a couple quick observations from looking at the markets here this afternoon. The S&P finishing up 0.7%. It's around 3175. The Nasdaq was up a little less than that. So this is one of those weird days, which I'm told happens sometimes, but I sure haven't seen it in a while, which is the market up, but technology down. Which is kind of an interesting development for sure. Tech has been, one of the top sectors. So the market went higher today. Small caps actually led the way up 1.6%. Mid caps up 0.9%. The VIX is a little lower, back below 28. So the S&P up. But look at what led the way higher. Financials up 3%, utilities up 1.9%, energy up 1.8%, consumer staples up 1.5%. The stuff that has been leadership, things like tech, biotech, healthcare, actually down today. So this was, to be honest with you, a weird day. It is not sort of a business as usual, things just kind of going higher. This is a bit of a rotation of sorts. People going into some of these beaten down groups that have been lagging. All three of these were, I feel like, have been at the bottom of the list most of this week. So sort of an interesting mix. And one of the other ways I just want to show you how today was kind of weird. This is the industry summary page. So the way you get to this is click on charts and tools, and then you'll see an option for industry summary. You can also get to it from your dashboard. What I do is I go on table view, and then I sort it by scooter rankings, which means you're looking at each industry group in order from strongest to weakness over the, essentially over the longer term trend. If you look at most sectors, you'll see the stuff that was down is at the top of the list, and the stuff that's up today, and that's the bars over here, are at the bottom of the list. So it's sorted by the long-term trend, and I'm showing over here the percent change today. So you can see within communication services, the biggest groups were broadcasting and entertainment, media agencies, which are some of the weaker groups within communication services. Consumer discretionary, a little weird because you have Tesla and the automobiles group going vertical essentially. So this one was sort of a mixed bag. But as we go on, you can see within consumer staples, biggest groups, tobacco, tires, which are at the bottom of the list. Within energy, the leading groups are coal, oil equipment and services, E&P stocks, which are at the bottom of the list, single digits, according to their scooter rankings. Within financials, the strongest ranked trends, which are specialty finance, financial administration, these are things like, boy, I shouldn't try to come up with names. I want to say this is like MSCI, S&P Global. I want to say those are those groups down, and the ones that are leading are these insurance and bank groups, which are at the lower end of the list. So I can keep going, which you can see with most sectors, the strongest moves today were the most beaten down groups. So this was certainly, and materials especially, look at this, gold stocks down at the top of the rankings. Things at the bottom, steel, aluminum stocks were actually up pretty meaningfully. So this sort of happened in most sectors outside of consumer discretionary, showing you sort of a right sizing. This is a bit of a rotation away from tech and some of the biggest leadership names into some of the other names. It actually led the market to go higher. So we'll look at those charts here in a moment. I thought it was an interesting sort of rotation of sorts just today, actually. Let's get to the Mindful Investor Live chart list. This is how we usually look at the markets together on a Friday afternoon. If you've not seen this before, if you've not looked at this chart list before, click on articles, go to my blog, which is called The Mindful Investor, and you'll see at the link at the very top to go to this live chart list. You can save it to your own login and use it however you want. We'll start with the long-term trend in the market. This is the S&P market trend that I followed for a number of years, and essentially gives a long-term, medium-term, and short-term, very systematic bull or bear call based on long-term moving averages. So the longest signal is based on the 21 and 34 week exponential moving averages, and the way you can look at that is the PPO here at the bottom. So if it's above zero, that means the trend is positive. If it's below zero, the trend is negative. This turned to positive in early June and has remained positive up through today. So overall, just saying that longer term, sort of that secular trend, the long-term cyclical trend is positive. What I call the medium trend is using the regular weekly MACD or the weekly PPO and just using them how they, the traditional signals when they cross up and down through each other. This turned positive in early May and has remained positive through today as well, just suggesting that medium term trend is positive. The short-term trend, I just use the difference between these two. And again, it's not a perfect read. I usually look at the daily chart more for it, but I find having them all in one chart can be kind of helpful. So I'm just looking at the difference, the histogram here, which shows you the width of these two moving averages, and the wider they are on the positive side, the bullish. In a bullish read. If it's narrowing or going negative, then it turns negative. And so for the last couple weeks, tactical short-term trend has been positive. So pretty much across the board, the trends are positive, and that's about what it feels like when you look at charts like Amazon and Tesla and Activision Blizzard and all these stocks that are overbought to extremely overbought. So the question obviously is, at what point do you see some kinks in the armor? I haven't seen them today for sure. Chart number 2 is looking at a daily chart of the S&P. There are a couple different things that we've noted here in recent weeks, if not months. The first was this bull flag, which was the big run out of the March lows, the parallel pullback, this corrective pattern of lower highs and lower lows, that resolved to the upside here in mid-May. This is when the S&P broke above that last Fibonacci resistance level, which measures, if you use the traditional measurement, it gives a target of S&P 3600. Which again, it's sort of suggesting if that's a midpoint in the trend, we've got a lot more upside. Now, more recently, we faced what I'd call a bullish pennant pattern, which is lower highs, higher lows, which has resolved to the upside. So it's broken above the trend line using these swing highs. We've now broken above this resistance of 3150. The challenge we've had on a day like today, great, we've broken above resistance. Yes, that should clear the way to continue on, arguably to 3,400 and retest the previous highs. This has happened, though, a number of times in the last week and a half, and every time we've done what we did today, the next day we end up going right back below 3150, and it just further establishes that as a resistance level. So today, nice breakout. I'd want to see a follow through into next week, and that's what I'd be waiting for there. Breadth by cap tiers is actually a really interesting chart right now. One of the questions in our mailbag is about advanced decliners, a really thoughtful question that I'll share with you and give you my take on it. But, one of the things I've noticing is this dispersion, this differentiation between breadth on the large cap stocks versus breadth on the small cap stocks. If you look at the cumulative advanced decline lines, this is taking the daily advanced decliners, just keeping a running total and looking at how they evolve over time. In general, when the market's going up, the advanced decline line is going to go higher. When the market goes down, the advanced decline line is going to go down, mainly because there are more down days in a downtrend and more up days in an uptrend. That makes sense. What you look for is when there are some divergences, right? Higher highs in the price, lower highs in the advanced decline line, or also when they differentiate on cap tiers. And I can't help but notice that the cumulative advanced decline line on the S&P has broken above its June high that happened earlier this week. If you look here at small caps, not only is it nowhere near its high from that same day, it's actually broken. This is as of yesterday's close, threatening to break down below the low from about a week and a half ago. So you have this situation where large cap breadth positive, everything else neutral, except for small cap, which is arguably a little bit negative. And what concerns me is if you look back at topping patterns, a lot of times that's what will happen. You can see that here in January to February, and this is much more of a clear read here over a month or so. Higher highs in the cumulative advanced decline for large caps, but then everything else kind of flat to down, and small caps especially sloping downward. So will be interesting to see if that's the same pattern that we're seeing here, but I can't help but notice it looks eerily similar to that pattern. Higher trend in the large cap breadth, lower trend in small cap breadth, and that tends to mean people are kind of going risk off and taking really speculative bets in small caps off the table. Looking at new highs, new lows, it's been relatively limited because, again, most stocks are sort of range bound, but you do have a handful of names like Amazon and others that are at or near new highs. That's pushing this to a consistent positive number. So over the last week, it's been about 30 to 40 plus stocks on the S&P, which, again, you think about that, it's about 6 to 8, 9% or so of the S&P making new highs on a given day. That's not outrageous. And in normal bull market phases, you'll see a much higher number. You can see back here in January, as we were getting to the end of this bull market phase before the February peak, you had over 20-25% of the S&P making a new high on a given day. We're nowhere near that. So it's not extended by that read, but again, it's a little different because we're sort of in, within this broad range for the overall market. Worth noting as we continue this discussion of long-term charts, less than 50% of the S&P above their 200-day moving averages. As I've mentioned, I would feel much better about long-term positive returns, expecting the S&P to get to 3,400 plus. If this would get back above 50%, which tells me over half of the S&P is back above their 200-day moving average, so many stocks still not able to do that. It's about 40% of names that are currently above their 200-day. So until that improves, I'm a little skeptical about long-term upside from here. It doesn't tell you there's long-term downside necessarily. It just tells you a lack of potential for a lot of upside from here. Also worth noting that we're back down to around 50% of the S&P above their 50-day. That's down from almost 100% just a couple weeks ago, maybe a month or two ago. Looking at a little bit of sentiment, the AAII rankings pivoted a little more to the bullish side. So bulls increased up to 27%, bears decreased down to 43%. So still, more bears than bulls to the tune of about 15-16%. But overall, that has narrowed. So over the last 3 weeks, you had a almost 2-to-1 ratio of bears to bulls. That's actually come in a little bit, which tells you individuals getting a little more optimistic, especially given this week with some further upside. This is a chart looking at strength within consumer. It really tells the story of Amazon. When Amazon does well, when a big mega cap stock like Amazon does very, very well, it's going to skew how a sector feels. So consumer discretionary as a cap-weighted sector doing very, very well, making new highs over the last couple of weeks. On an equal weighted basis, and this is versus consumer staples, on an equal weighted basis, it's actually making new swing lows this week. And that can happen because Amazon is such a big weight. When you take that overweight out and you equal weight all the consumer discretionary stocks, you can see that it's less attractive just being a consumer discretionary. There are opportunities within staples, but the relative strength of consumer discretionary versus technology remains fairly negative. Semiconductors have been strong and remain so. A bit of a pullback today as tech has sold off, but overall, it's been interesting. This is a key chart to pay attention to, and I think there's a sort of an inflection point alert here. Small caps have been outperforming since just before the March low. That potentially has certainly changed here with breaking down through this uptrend channel from the lows. This is the IWM, the Russell 2000 versus the S&P, sort of rotated lower below the lower item here. Growth continues to outpace value. I don't see that changing today, and certainly don't see that changing based on the chart. That still favors growth over value. High beta has come in a big way versus a low vol. That's not a new thing this week. That's actually been evolving for quite a while. And then very finally, I just want to point out the fact that emerging markets have certainly emerged very strong. We're going to look at a chart of China here in a minute, but it's worth noting U.S. has been underperforming global stocks for the last 2 months, and that's based on weaker dollar and a number of other things as well. I'd encourage you, again, if you, as with many investors, I think very rightfully so, have ignored looking at international markets because U.S. markets have been so much better suited. The relative performance has been here, and I get it. That's changed, though, and because of the weaker dollar, you're seeing trends emerge outside the U.S. that are worth paying attention to. Finally, I haven't updated the arrow here, but I think you'd put maybe an amber arrow right now, sort of showing that stocks and bonds are sort of in lockstep. Stocks sort of drifting higher this week, bonds breaking out of congestion range as well. So overall, it's sort of been either or. They're both appreciating in a pretty decent clip this week. That is our wrap the week segment for today. And again, a lot of just sort of big picture charts to review. Again, overall, this has been a week of consolidation, but certainly finishing stronger relative to some of the other days this week. For me, as we close higher on a Friday, I want to see follow through on Monday. You know, some good news, I think, in terms of coronavirus and news from Gilead on drug treatments, but you know, the weekend can bring a lot of news as well. So let's see what Monday brings to us. If we do get a follow-through day to the upside, I think that certainly clears the way for being more optimistic about further upside in stocks overall.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.